The market dropped 6.8% over the last 13 weeks. My portfolio collected $968 in income anyway. Not because I got lucky, not because I predicted anything correctly, because I use a strategy that literally doesn't care which direction the market moves. I'm going to show you exactly how it works in the next 20 minutes. Before we get into anything, I want to be upfront with you. I'm not going to ask you to buy something today. I'm going to show you a strategy, how it works, why it works, what the numbers look like. At the end of this video, if it makes sense for your situation, there will be an option to take a next step. If it doesn't, you'd still walk away understanding a system that most retail investors never learn. No pressure, no pitch, just the work. 13 consecutive weeks, 13 different market conditions. The market went up, down, and sideways in this 13-week time frame. The income came in every single time, not because I predicted correctly, because I followed a process. My name is Marcus. I'm a retail options trader, not a hedge fund manager, not Wall Street. And in the next 20 minutes, I'm going to show you exactly how this works. But most of them are using them the wrong way. They're buying them. And here's why that matters. The Montreal Exchange published research showing that options buyers win roughly 1 in 6 trades. Options sellers win 5 in 6. Same market, same instrument, completely different result, based entirely on which side of the trade they're on. Most retail traders are on the wrong side. This video is about getting on the right one. Let me ask you something. If you have $25,000 to $50,000 in investable capital right now, where is it sitting? A savings account, a brokerage account holding index funds, a 401k you barely look at? Here's what that money is generating for you today. A high yield savings account at the current rate of around 4.5% gives you roughly $1,125 a year on $25,000. That's $93 a month. The S&P 500 averaged about 10% annually over long periods. On $25,000, that's $2,500 a year, $208 a month. But here's the catch with both. You don't see any of that income until you sell. It's all on paper. So the strategy most investors are relying on offers no income, unpredictable outcomes, and requires you to hold for decades just to find out if it worked. Now look at what the same $25,000 can do with the wheel strategy. Targeting a conservative 2 to 4% return per month on capital deployed, that's $500 to $2,000 per month. Not at the end of the year, every week. That's the difference between hoping your money grows and actively being paid by it. The wheel strategy works on a simple principle. Instead of buying a stock and hoping it goes up, you sell someone else the right to buy or sell that stock to you. And they pay you a premium for that right, upfront every week. That premium is yours to keep regardless of where the stock goes. It's called selling options, and it is structurally different from everything most retail investors have ever tried. Step 1, you select a quality stock. We're not chasing news, we're not buying momentum. We're looking for a stable, liquid company we genuinely be comfortable owning. Step 2, we sell a cash secured put. I sell a put option with a strike price of $195 expiring in 1 week for a premium of $75. That money, $75 for 100 shares, hits my account immediately. I'm agreeing to buy this stock at $195 if it drops below that level. But I'm getting paid $75 to take that obligation. If the stock stays above $195 by expiration, the option expires worthless. I keep the entire premium. I do it again next week. And here's how we select that strike. We use delta, which gives us a rough probability guide. A delta of zero point 0.3 means roughly a 30% chance the option will be assigned, meaning a 70% chance we keep the full premium and do it again next week. We're not predicting, we're selecting setups where the probability is already in our favor. Now let's say the stock does drop and we get assigned. We now own 100 shares of NVIDIA at $195 per share. Now we sell covered calls against it. Strike of $205, same expiration window for a premium of $106. Another $106 deposited to the account. Week after week, that premium reduces our cost basis. Research by the S&P Dow Jones Indices confirms that covered call strategies directly affect the net cost basis of the underlying position, systematically improving your entry over time. Let me show you what this looks like over 4 weeks. Week 1, cost basis is $195. After the put premium, $194.25. After week 2's covered call, $193.19. After week 3, $190.75. Your break-even price drops every single week you execute, even if the stock hasn't moved. One thing I want to address directly. Most people are scared of getting assigned. In the wheel strategy, assignment is not a failure condition. It's a planned outcome. You selected the stock because you'd be comfortable owning it. You set the strike at a price you'd be comfortable buying it at. And you got paid to take that obligation. If you get assigned, you move to the next phase of the wheel. Nothing has gone wrong. The process is working exactly as designed. Let me tell you about Moises. Before my program started, Moises had limited options experience and was seeking a consistent form of income. He started with $5,000 in deployable capital. His first trade was SoFi. He sold a put at $27 and collected $37 in premium. He was assigned at $37 and bought 100 shares, but stayed calm and executed the plan as instructed. By the end of month 1, he had collected a total of $157 in premium. By month 3, he was averaging $130 a week in profit. The strategy and his execution started to pay off slowly but surely. He didn't succeed because he was exceptional. He succeeded because he followed the process. Week after week, trade after trade. And Moises isn't the only one. Chad is using the same system to generate supplemental retirement income. Carlos struggled with emotional trading, stuck to the plan, and now sees the value of following a structured approach. Lastly, Carrie had tried learning options on her own, made some mistakes, and now fully understands how to execute the strategy correctly. Same framework, same results, different people. If you've tried options before and lost money, I want to reframe that for you. You didn't fail because options don't work. You failed because of which side of the trade you were on. NIH research showed that high levels of emotion degrade trading decisions quality. Navia's research confirmed that stressed traders struggle to analyze market data accurately. Buying options is a high emotion, high prediction activity. One wrong guess and the position decays to zero. Selling options is different. You're not predicting, you're managing. The Van Tharp Institute found that position sizing accounts for 91% of performance variance among traders using identical strategies. Structure and process, not intelligence or prediction, determine the outcome. You don't need to be smarter this time. You need a better system. What if the market crashes? That is the most common question I get, and it's the right one to ask. But here's what actually happens in a market downturn with this strategy. First, when volatility spikes, options premiums increase. You get paid more per trade. Second, if you get assigned on a stock that continues to decline, you are selling covered calls every week. Each week of premium reduces your cost basis further. Third, you only run this strategy on stocks you'd be comfortable holding through a downturn. Quality companies that historically recover. No strategy is risk-free. This one is designed to generate income in any condition and to systematically lower your risk exposure over time through premium collection. How much time does this actually take? This is not a day trading strategy. The full weekly execution process takes most students approximately 30 to 60 minutes per week once they're up and running. You're not watching a screen all day. You're selecting a trade, placing it, and reviewing it once a week. The goal is a system that fits into your actual life. Let me make this concrete for you. The program is $2,000. With $50,000 in starting capital, the framework we teach targets a conservative $250 to $500 per week. At the low end of that range, the program cost is recovered in approximately 8 weeks of execution. Not years, not months, weeks. After that, every premium collected is income the strategy generated, not capital you deployed. The question isn't whether the $2,000 is worth it. The question is whether you want to spend the next year figuring this out alone, or spend the next 4 to 8 weeks learning it with structure. The Wheel Strategy Mastery Program is a 6-week structured mentorship, not a course library you work through alone, not a signal service where I tell you what to trade. A mentorship, meaning you execute real trades with real capital and you have coaching and accountability through every step of it. What's included? A weekly one-on-one coaching call. We review your actual trades, not hypothetical ones. We identify where your execution is strong and where it's costing you. Research from JLL found that organizations with structured mentoring generate median profits 3 times higher than those without. That is why. Complete trade framework, stock screener, strike selection rules, delta targets, position sizing calculator, assignment management protocol, rolling logic. Every decision has a rule. You never have to guess what to do next. Here's what I want you to consider before you make a decision. Your capital has a cost of waiting. Every month that $25,000 sits in a savings account at 4.5%, it generates $93. Every month it sits in an index fund, it either grows or it doesn't, and you have no control over which one. And every month you spend trying to figure this out alone through YouTube videos and Reddit threads and scattered courses, you're not just not generating income. You're absorbing the cost of bad trades, inconsistent position sizing, and emotional adjustments. Cornell research found that not knowing what you don't know is one of the leading causes of bad financial decision making. The cost of that trial and error on a $25,000 account is not hypothetical. It's measurable. The program exists to collapse that timeline. If what you've seen makes sense, here's what happens next. Below this video is a short application. It takes about 3 minutes. It asks a few questions about your current capital, your experience with options, and what you're trying to build. If the fit is there, we'll schedule a call. On that call, I'll answer any questions you have, walk through any specifics about your situation, and we'll both figure out whether this is the right next step for you. No hard sell, no pressure. If it's the right fit, we work together. And if it's not, you'll still leave the call with a clearer picture of your options. The application is below. I'll see you there.